Time now for our continued special series, Beat the Street. Today, we're speaking with Doug Foreman, manager of the Virtus KAR Midcap Growth Fund. Get this, his fund up 25% this year. And we spoke earlier with Doug about how he is managing to beat the street.
We're quality investors. We're bottom-up oriented, and a lot of businesses that we've been invested in over the last 12 months or so have done exceptionally well. And the market's rewarded them with an increase in stock price because their business fundamentals have continued to improve. So we have been overweight some areas like technology, which have obviously done very well over the last 12 months, despite the fact that some of the stocks are struggling a little bit here short term.
Are you even surprised by the performance? I mean, up 33% over 12 months?
I've been doing this a long time, Brian, and, I'm never quite sure when the market's actually going to pay for the fundamentals that the companies are delivering. There's all kinds of noise in the marketplace that can dominate trading in the short run. But over the long run, the businesses we own have been doing very well, actually, for a very long time and continue to do well. So never quite sure when you're going to get paid for that fundamental progress, but we just hang tight and hopefully the market eventually rewards us.
Do you think the market finally is? Are we paying for fundamentals? Do fundamentals matter?
Fundamentals definitely matter. I mean, you've seen that over the last several years. I mean, the market, every day that goes by, right? If a company comes in short of expectations, the market punishes it. And when the companies are exceeding expectations over time, the market is rewarding it. So that's nothing new. I've been doing this 30 years, and that the market seems perfectly rational in that respect.
What is really interesting about your fund is that obviously you've got some sort of smaller, lesser-known picks we're going to get to in just a second, but you've also ridden the Netflix wave. Netflix, one of these companies that has obviously been well-loved, part of the FANG group of stocks, but had its volatility as well. Are you still a big believer in Netflix? Are you still a big holder in Netflix?
We still hold the stock. We still are a big holder. We bought it several years ago when it was a mid-cap stock. And, in our mid-cap strategy, we don't just, line up quickly to sell a stock once it leaves the mid-cap index, especially when we don't believe that the market really fully appreciates still just how good this business really is. And so I still feel a lot of large-cap managers still don't believe in Netflix, and so we've continued to hold it. But at some point, we will take it out of the portfolio because of its size.
That's what's interesting. If you're a smaller mid-cap portfolio manager, you bought it when it was much smaller. It's clearly not a small company anymore, about $150 billion or so market cap. How long are you sort of allowed to hold these bigger stocks? I mean, do you just hang on to the big ones or say, no, guess what? This is it's not what we do. We got to rotate back out.
Well, we rotate back out, but we take our time in doing that. We're not slaves to some particular market cap, 30 billion or 40 billion or 50 or even 100. It's really a case-by-case basis, and obviously Netflix has gotten to the market cap that it's gotten to fairly quickly over the last several years. But, their business and their subscriber growth has been way above what people would have expected 2 or 3 years ago, which is why the stock's done so well. So we're not in any great hurry, but we do try to recycle and obviously stay within the mid-cap index overall, and all of our new purchases are always in the mid-cap range.
We had Pepsi buying SodaStream. Everybody's kind of shifting away from carbonated beverage, but energy drinks have been hot. You've been an owner of Monster, MNST. What is so attractive about the energy drink space, which, by the way, has gotten extremely crowded over the last couple of years, Doug?
Yeah, Monster and Red Bull still dominate the category. Monster's still taking market share. They're doing very well domestically in a category that, a lot of soft drinks aren't growing at all or very little, low single digit. The energy drink category is still one of the fastest growing beverage categories out there. And Monster in particular has a unique opportunity to really expand its business overseas, which it's doing with Coca-Cola's help. Coke bought a major stake in the company about 4 or 5 years ago. And so they're using Coke's distribution model, which is very powerful overseas, to expand their brand overseas. And we think they got a long runway to go and become a much larger company as they do that.
One of my favorite things about this series that we're finding names that we haven't talked about much, if at all, on CNBC, Avalara, AVLR. Who are they? What makes them attractive to you, Doug?
Avalara is a recent IPO, so it's a relatively young company, a little bit earlier in its life cycle than most of our holdings. But Avalara, we believe, has pretty tremendous potential over time. What they do is sales tax software. So if you're a small, medium-sized business and you're selling online, you're selling in 50 different states and you've got 50 different tax jurisdictions, there's 80,000 different tax jurisdictions in the U.S. alone. So sales tax, while it sounds like it's fairly simple and easy to calculate, standard 8% or whatever here in the state of California, is actually incredibly difficult when you start selling online. And so Avalara has a clear lead in this space. It reminds us of the payroll space 20, 30 years ago, where no company in its right mind is going to attempt to do this on their own. They're going to outsource this. They're going to hire a third party. And Avalara is a clear early leader in this space. Yep. So we find it very attractive for those reasons.